Welcome to our 2016 annual client presentation. I want to take this opportunity of wishing you and your family a truly blessed 2016, trusting for good health and wonderful things for you and your family. 2016 is quite a marker year for Lynn and I because it was 20 years ago, it'll mark 20 years ago since Lynn and I and our two then teenage sons arrived in the United States. We have learned that America is still the land of great opportunity for those who work hard and serve others with integrity. We love America and we are proud today to be Americans. Yes, we face challenges in this country and around the world, but one thing I've learned about Americans is that they are always more than equal to the task. And so I want to encourage you this year not to be too burdened with the things that are going on around the world and the political infighting that might take place in a presidential election year. This is still a great country and great opportunities in it. It was just a few months ago that I was teaching a class on financial education to a group of smart 15, 16-year-olds at a local high school. And I said to them, that you were truly privileged to be born in America, but that alone does not entitle you to a great job. It is going to be hard work starting now and through college and into your careers. It's going to be diligent service to others that is going to lead you into great careers. So I encourage you to make the most of this great country. As we look at 2015 and look back for a moment, I would say that in terms of the financial markets, 2015 was one of the most challenging years we have experienced in the financial markets. We faced a number of major economic cross currents. By now you may have forgotten, but the first 6 months of 2015, we were consumed with the financial crisis in Greece. We have experienced a collapse in energy prices and other commodities, and we went through many concerns about the US Federal Reserve Board raising interest rates. We experienced a global stock market correction during the summer of 2015. We've seen an incredibly strong United States dollar, and we've also experienced unprecedented liquidity from major central banks. Just one of these cross currents would have been enough to deal with in 2015, but we had all these and then some, making it a particularly challenging year to be managing portfolios. So as we look back at 2015, we look at the performance of global stocks as measured by the Morgan Stanley All-Country World Index. It lost 2.36% in 2015. Global bonds as measured by the Barclays Global Bond Index lost 3.15% during 2015. Commodity prices slumped and cash produced very little in the form of returns. By the time we'd arrived at the beginning of 2015, we had by then already experienced 6 years of a strong bull market starting near the beginning of 2009. This type of performance going on for so long usually leads to some kind of correction in the stock market. Well, we had that in the summer of 2015 when stocks globally corrected by more than 10% as they collapsed around the world. Fortunately, we saw a recovery of most of that loss. So as I turn to 2016 and we look forward, what is it that we're expecting in 2016? We expect global gross domestic product, which is a measure of the growth of the US economy, to grow by between 2.3 and 2.5%, about the same as the growth in 2015. We expect core inflation, that's inflation on everything except energy and food prices, to rise somewhere between 1.7 and 2%, a little higher than the 1.5% we likely saw in 2015. We expect the United States Federal Reserve to raise interest rates further. We expect the US stock market to have a choppy uptrend and to end modestly higher at the end of 2016. Further, we expect technology and healthcare sectors to continue to perform very well. As you know, we've held positions in those two sectors over the last year and will continue to do so for 2016. We expect bonds to continue to struggle in 2016. In terms of the United States economy, manufacturing has been weak. We can expect it to continue to be weak. But on the other hand, consumers have come out in force and consumption has been strong in the United States and should help support the United States economy. Looking at the global economy, what do we expect for 2016? We expect the global economy to grow modestly at 3.2 to 3.5%, again about the same as 2015. We expect the weak recovery in Europe to accelerate in 2016. We expect European, Japanese, and Asia-Pacific stocks to perform well in 2016, and we also expect the United States dollar to remain strong compared to other global currencies during 2016. Looking at the US stock market, and maybe a repeat of some of what I've said already, but we, together with many others, believe that the US stock market is at least fully valued to maybe even slightly overvalued. While we expect the US economy to grow, we expect the stock market in the US to experience a choppy, somewhat volatile uptrend in 2016. With a little bit more detail, we expect large company US stocks to outperform small company US stocks, and right now we do not hold any small company US stocks in our portfolios. Looking at global stocks and our projections for global stocks, we expect that European, Japanese, and Asia-Pacific stocks will do particularly well. They are undervalued stocks in those particular regions and therefore provide opportunities for investment. Undervaluation is, in a sense, a good thing because it means that there's less risk of major drops in undervalued positions. Therefore, we have also opportunities for greater growth and less risk to our portfolios by holding undervalued position. So we expect stocks in Europe, Japan, and Asia Pacific to experience significant gains over the next 2 years. Part of the reason for that is that we expect the central banks of Europe, the European Central Bank, and Japan, the Japanese Central Bank, to add quantitative easing, meaning that they essentially will print money to provide liquidity into their economies, and that generally has resulted in great increase in stocks in the regions where quantitative easing is being applied. Let's turn to China for a moment as a specific entity in the global economy. It has become one of the largest economies in the world today. It is an economy that is transitioning by intent to a consumption-based economy, meaning consumers creating the activity in the economy. At this stage, only about 50% of the Chinese economy is based upon consumer activity. That's compared with the United States, where about 88% of economic activity comes from consumers. This is a good thing that China is doing in transitioning to a consumption-based economy and should result in a much more stable economy for them going forward. Unfortunately, it'll also lead to some volatility, as we've already seen during 2015 and the early part of 2016. We believe that everything points to that transition working out well. Regarding emerging markets, of which China is one, we expect those that import commodities to do much better than those that export commodities. Why? Because commodity prices like oil just generally are very low currently. I want you to take a look at this chart of the All Country World Index. This is the index for global stocks, and this particular chart shows a comparison between the performance of the All Country World Index in 2011 going into 2012 compared to the performance of the same index in 2015 going into 2016. The 2016 performance appears, 2015 performance appears as a red dotted line. The 2011-2012 performance appears as a blue solid line. It's very interesting to see how much there is a similar trajectory between the performance of those two periods. We are not necessarily saying that the trajectory will remain the same as we head into 2016. In the way we hope it does, because it points to a nice uptrend in global stocks. We'll certainly be watching that chart as we move forward. Something that's very much on the minds of investors and the consumer press, especially for the financial press, are the topics of inflation, interest rates, bonds, and the United States Federal Reserve. The Federal Reserve has a twofold mandate, and that is to use everything at its disposal to produce an environment that will create sufficient employment in the country, and secondly, to use tools that will limit inflation. Over the last year or so, we've seen an incredible increase in employment and decrease in unemployment, such that as we came into the end of 2015, unemployment was running at around about 5%. In Fed speak, that's considered to be full employment. In other words, they've achieved a level of unemployment with which they are somewhat satisfied. And so we anticipate that their focus over the next year and years is going to be on the other major topic they have to deal with, which is inflation. We've seen wage pressures beginning to rise. There are certain categories of jobs in which there is a shortage of employees, and therefore more higher salaries are being paid in order to attract employees into those jobs. Wage pressures typically lead to higher inflation. When you have higher inflation, the Fed typically will raise interest rates in order to counter that inflation. And so we expect that there might be rising interest rates going on through 2016. One of our biggest concerns is that inflation will rise faster than most people, even than the US Federal Reserve is expecting presently. If that were to happen, the Federal Reserve would have to raise interest rates even faster than everyone was expecting, and that would not be good for either stocks or bonds. Needless to say, this is something that we're keeping a very close watch on during the course of 2016. As a result of rising interest rates, we of course expect that bonds will continue to struggle in 2016. Over the last few years, we have spent increasing time researching private investments. And our research, we're finding, is benefiting all of our clients. Private investments, just to explain, are investments that are not publicly traded. They are generally illiquid, and they have unique traits that are beneficial to a portfolio constructed of both private and public investments. Publicly traded investments are typically liquid, are usually stocks and bonds, mutual funds, etc. Private investments, on the other hand, are typically only available by law to what the law calls accredited investors. So what is an accredited investor? An accredited investor is someone who has a net worth of at least $1 million, excluding their primary home, or has a salary or income of at least $200,000 per year, or where a couple has a salary or joint income of at least $300,000 per year. If you fall into any one of those categories, the law considers you to be an accredited investor, and private investments can only be offered to accredited investors. We've had a number of our clients over the most recent years invest in private investments and benefit from that, and we've continued to do research on private investments. And every now and again, our research leads us to unearth publicly traded investments that normally would only be available as private investments. So, for example, in the last month, we added the Stone Ridge Reinsurance Risk Fund to our clients' bond portfolios. We unearthed this fund specifically as a result of our research into private investments, and we're so glad that all of our clients could benefit from this particular fund. This reinsurance risk fund falls into the category of what's normally called catastrophe bonds, or for short, cat bonds. Cat bonds have characteristics that are not dissimilar to investment grade bonds. They have about the same risk level as investment grade bonds, but in the most recent 7-8 years have produced returns in the region of 7% per year, much more than we expect that typical investment grade bonds will return. What I also love about this particular fund is that it invests alongside reinsurance companies in reinsuring all kinds of risks all over the world, but particularly weather and catastrophe related risks. If you can imagine for a moment, or maybe if I was to ask you this question, considering how many times you've made a claim on your insurance policy, would you rather be buying insurance or selling insurance? I think most of us would answer we'd rather be selling insurance, because it seems when we buy it, we never seem to get anything back from it. So this is exactly what the Stone Ridge Fund does. Alongside the major reinsurers of the world, it's actually providing reinsurance for major catastrophes around the world. So think about it for a moment. Everything else we invest in, stocks and bonds, is impacted by things like inflation, interest rates, economy, etc., etc. Storms, on the other hand, are totally unrelated to any of those economic factors. So what we do by introducing an investment like this is to bring an investment that is totally uncorrelated to the performance of the other things that we hold within our portfolios. When we add a non-correlated investment into our stock bond portfolios, typically the result is to reduce the risk of that portfolio and to increase the returns of that portfolio. That's classic portfolio management theory. We believe that the Stone Ridge Fund is going to do just that for our portfolios. But further on private investments, for those of our clients who are accredited investors, we are introducing during the first quarter of 2016 the Hopkins Capital Partners Fund. It's a fund designed to hold a diverse portfolio of private investments. We've come to believe over the years that wealth is built in the private markets, while liquidity is provided by public markets. We believe further that a portfolio constructed of both public and private investments has the potential to produce superior returns with reduced volatility. And we're excited to be offering this fund to our accredited investors this year. One of the things I thought you'd be interested to look at as I change gear a little bit on that topic is to provide you with a window into the Hopkins Investment Management team thinking. We meet regularly, sometimes once a week, sometimes more often, sometimes a little less often. But we are driven constantly by a priority set of rules as we make decisions concerning your portfolio. These 3 rules, very simply, are number 1, and in this order, capital preservation, number 2, performance, and number 3, tax optimization. Capital preservation, we achieve this in a number of ways. Number 1, we avoid or reduce exposure to overvalued investments. Number 2, we seek opportunities in undervalued investments. We use intelligent diversification, and sometimes we hold cash to one degree or another. Performance is our number 2 priority. It's obviously important to all of us. And we seek to outperform our benchmarks, net of our fees, over any 3 to 5 year period. That means we may underperform in shorter periods of time with a view to, or with the goal of outperforming in 3 to 5 year periods. And then number 3, tax optimization. Minimizing taxes is really important to us, such that every time we trade, one of the important issues we consider is the tax impact of the trades that we are making, not only on that day, but the cumulative impact of the trades that we are making regarding taxes for that particular year. So let me use a simple example to show you how we implement this priority list of capital preservation, performance, and tax optimization. In 2011, we held gold in our client portfolios. Gold had had a huge run-up at that stage and had reached a price of around about $1,800 an ounce. At the time, we felt concerned that there were more risk that the price of gold would drop rather than the opportunity for it to rise. So we made a decision to sell gold. We knew that it would result in significant taxes because there were going to be significant gains. But we were more concerned about number 1, capital preservation, and number 2, performance. Well, gold today is trading at around about $1,000 to $1,100 an ounce, more than 40% lower than it was when we sold it in 2011. That's where we see the importance of the interaction between these 3 priorities taking place. We put capital preservation first, performance second, and tax optimization third. Unfortunately, the challenge is that these 3 priorities are often in conflict with each other, as in the situation with gold, where the conflict was we were going to create a tax situation, whereas we had to follow our priority of capital preservation and seeking performance. That worked out well for us. I also want to turn to a topic today which we don't hear spoken of much in the financial markets or the financial press. And it's the topic which I call major market inflection points, and related to that, diversification and capital preservation. You hear me talking about capital preservation because that's an absolute priority to us. Steve Ames, who many of you know and who serves on our investment committee, has said many times, and I agree with him, that the only free lunch on Wall Street is diversification. Diversification means we don't put all our eggs in one basket, but that we diversify into a number of investment types so that we do not take the risk of one of them failing seriously. So let's take, for example, just what happened in the S&P 500 in 2015. As the name S&P 500 implies it represents 500 leading stocks in the United States. You might be interested to know, and this comes from information provided by Goldman Sachs, that more than 50% of those 500 stocks had a loss in 2015. And if it weren't for somewhere around about 4 or 5 stocks that had particularly good performance, and I'll come back to those, but that had particularly good performance, we would have had much worse result in the S&P 500 in 2015. Though 4 of those stocks have become known as the FANG stocks, F-A-N-G, which stands for Facebook, Amazon, Netflix, and Google. Those 4 stocks accounted and did all the heavy lifting in the S&P 500. But I want you to imagine for just a moment, what if they had gone in exactly the opposite direction and were the big losers of 2015, which by the way, they were on the first trading day, January the 4th, 2016. We would have had a completely different scenario. That particular picture and illustration illustrates why it's so important for us to be diversified. So going on with this topic of major market inflection points, let's take a look at this chart of the NASDAQ index and its performance from 1995 to 2004. You'll see that particularly in 1999, in the height of the dot-com era, that its performance just skyrocketed right into the end of 1999 and continued into the first few months of 2000. Our strategy would have had us make a change in the early part of 1999 out of large growth stocks which incorporate the high-flying technology stocks of the NASDAQ, and would have had us change into some of the old company stocks called large value stocks. Value because they were undervalued compared to the extremely overvalued stocks of the NASDAQ. So as you look at this chart, you'll see it reach to a peak and then suddenly collapse. Well, we had made that change into large value stocks, and for 1999, reporting of performance was pretty sad for us because our performance looked really sedentary versus what had happened in these large technology stocks. But late in March 2000, the bottom fell out of the NASDAQ and it collapsed. And would you believe it, the large value stocks that we then held up really well because they were not overvalued, and we had wonderful performance in 2000. So sometimes we make an early move to avoid overvalued stocks, and it looks in the short term like we underperform. But in the long term, when you make changes like that, often it pays off for performance. We believe that when we look at US stocks today, and especially the S&P 500, it may be reaching an inflection point, especially compared to the stocks of other companies around the rest of the world. We believe stocks around the rest of the world are somewhat undervalued, and that the S&P 500 stocks may actually be overvalued at this time. For this reason, we've been making a move progressively away from US stocks and into international stocks or non-US stocks. We still hold a significant portion of our portfolios in US stocks. We've simply reduced in favor of international stocks. I believe, and we believe, that it was appropriate for us to make this change in order to avoid subsequent bigger losses. If we take a look at the chart of the S&P 500 from 2005 to 2015, you'll see just how strongly it has grown over the last 7 or 8 years, but it does seem to have reached a level at where it is struggling. So as we come to a conclusion on this video, it's been wonderful just chatting with you, and I want to thank you for listening to this presentation. I want to say to you that I believe that our portfolios are well positioned for the most likely scenarios that we anticipate during 2016. I believe it'll be interesting for you to know that 3 of our investment team, that's Steve Ames, Jenny Ignaski, and myself, have combined investment experience of over 60 years. And we work hard together with Wes Lyons from our team to use that investment experience in managing your portfolios. We follow a discipline that's aimed at preserving your capital, optimizing performance, and optimizing for taxes. We consider it, and I don't use this word lightly, but we consider it a sacred trust to be managing your portfolios. And I want to say just how much we appreciate that you have handed to us the responsibility for managing your portfolios. I want you to know that every day we take that incredibly seriously and work hard in order to do the very best that we can for you. I trust that 2016 is going to be a truly blessed year for all of us, and especially our portfolios.